Stock Market for Real People. Simple Steps to Stock Success. Audiobook. Reading by Coleman Hudson. Published by A1 Audiobook. Introduction. Let's be direct. This book was written to make your life better. Not just your financial life, but your entire life. Because when you solve the problem of money, when you transform it from a source of constant stress into a tool that works for you, everything changes. The weight on your shoulders gets lighter. The future looks brighter. The world opens up in ways you may have only dreamed of. The decision to read this book, to truly absorb its lessons and put them into practice, will be one of the most important and profitable investments you ever make. In these pages, you will find the solution to a problem that plagues millions of Americans, the feeling that you're on the outside looking in. You see the headlines about the stock market creating wealth. You hear the stories of people securing their retirement, but it all feels like a private club with a secret handshake you were never taught. You're standing in front of a heavy, ornate door, and you're certain it's locked. This book is the key. Choosing to turn this key and open that door will become a cornerstone of your success. I know what you might be thinking, because I've been there. You've probably tried before. Maybe you opened a brokerage account, bought a stock that a friend or a TV pundit recommended, and watched it go nowhere, or worse, go down. You felt the sting of that loss, not just in your wallet, but in your pride. You felt foolish. Or maybe you've been too intimidated to even start, paralyzed by the confusing jargon, the flashing charts, and the paralyzing fear of making a costly mistake. You've told yourself, I'm just not a numbers person, or it's too risky, or the game is rigged for the big guys anyway. I am here to tell you that those feelings are valid, but those beliefs are wrong. The problem isn't you. It has never been you. The financial industry has a vested interest in making investing seem complex, risky, and inaccessible. Complexity is a product they sell. Confusion allows them to charge high fees for expert advice that often fails to deliver. This book is an act of rebellion against that system. It is designed to take the power from Wall Street and place it firmly in your hands, the hands of real people who work hard for their money and deserve to see it grow. The problem defined. For the average American, the stock market presents a terrible choice between two losing propositions. Option 1, the casino. You treat the market like Las Vegas. You jump on meme stocks, you chase hot tips from social media, you buy into crypto crazes without understanding them. You're not investing, you're gambling. This path is paved with anxiety, sleepless nights, and the near certainty of financial loss. It's a thrilling ride that almost always ends in a crash. Option 2, the sidelines. Terrified by the casino, you choose to do nothing at all. You keep your hard-earned money in a savings account where it feels safe. But it's not safe. Every single day, a silent thief called inflation is robbing your money of its purchasing power. The cash sitting under your mattress or in a low-interest account is losing value. By trying to avoid all risk, you have guaranteed a slow, certain loss. This is the trap. You are forced to choose between the fast-moving train wreck of speculation and the slow-sinking ship of inaction. It's no wonder most people feel hopeless. They know they're missing out on the single greatest wealth creation engine in modern history, but the price of admission seems to be either their sanity or their savings. The promise. This book offers a third way. A better way. We are going to systematically dismantle the idea that investing is gambling. We are going to replace fear with a process and anxiety with a plan. I am going to teach you a powerful step-by-step method I call the Financial Fortress Framework. This is not a get-rich-quick scheme. It is not about timing the market, day trading, or finding a secret loophole. It is a get-rich-for-sure strategy built on time-tested principles used by the world's most successful investors, but simplified for anyone to understand and execute. A fortress is not built in a day. And it is not built with flimsy materials. It is built methodically, with a solid foundation, strong walls, and a clear view of the surrounding landscape. It is designed to protect what is most valuable to you, and to stand strong through any storm. This is exactly how we will approach building your wealth. Using this framework, you will cease to be a gambler or a spectator. You will become the architect of your own financial destiny. You will learn how to identify wonderful, durable businesses, how to buy them at a fair price, and how to construct a portfolio that works for you, day and night, year after year.
You will gain control, confidence, and clarity. The Roadmap, your journey to becoming an architect. Our journey together is logical and progressive. Each chapter builds upon the last, laying another crucial stone in the construction of your financial fortress. First, we will pour the foundation. In chapters 1 and 2, we will tackle the most important variable in your success, your own psychology. We will rewire your brain to think like a business owner, not a gambler, and introduce a powerful system to separate your emotions from your money. Next, we will draft the blueprint. In Chapter 3, you will create your own professional-grade personal investment plan. This document will become your compass, guiding every decision you make and keeping you anchored to your goals. Then we will learn the language of the builders. Chapter 4 demystifies the jargon of Wall Street, turning confusion into confidence. With our plan in hand, we will select our building materials. Chapters 5 and 6 introduce the MOAT Checklist TM, a simple filter to find extraordinary companies and teach you the art of buying them at the right price. Then the construction begins. Chapters 7 and 8 provide a masterclass in how to intelligently build your positions and, just as importantly, the disciplined, predefined rules for when to sell. Once built, we will learn to defend the fortress. Chapter 9 is your action plan for surviving and thriving in a market crash, turning panic into the single greatest opportunity of your investing life. For those who want a simpler path, Chapter 10 reveals how to use ETFs to build a powerful, prefabricated fortress with minimal effort. Finally, in Chapter 11, we will ensure your fortress becomes a legacy, adapting it through life stages and creating enduring wealth for generations to come. The door to your financial future is right in front of you. You may have thought it was locked, but it was merely closed. The key is in your hand. Turn the page. Let's begin.
Chapter 1. The most important investment, and it's not a stock. What if I told you that Warren Buffett, the most successful investor of our time, could personally call you up, give you the name of his single best investment idea, and you would still likely find a way to lose money on it? You'd probably think that's absurd. A stock tip from the master himself? That's a guaranteed ticket to riches. But it's not. The greatest stock pick in the world is worthless if the person holding it doesn't have the right mindset. They will panic during the first dip and sell too early. Or they'll get greedy when it shoots up, buy more at the top, and then get wiped out in the correction. This reveals the most important secret in finance, a truth that Wall Street rarely discusses. Successful investing is not an external game. It is an internal one. The battle for your financial future won't be fought on the floor of the New York Stock Exchange. It will be fought in the 6 inches of space between your ears. Your biggest enemy isn't a market crash or a bad economy. Your biggest enemy is your own beautifully, wonderfully, and catastrophically ill-equipped human brain. The first and most critical investment you will ever make, the one that determines the success of all others, is the investment you make in understanding and managing your own psychology. This is the bedrock of your financial fortress. Your brain on money, a design flaw. Your brain evolved over hundreds of thousands of years to do one thing exceptionally well: keep you alive.
It is a finely tuned survival machine designed to identify immediate threats, like a tiger in the bushes, and seek immediate rewards, like a ripe fruit. This ancient wiring is fantastic for navigating the physical world. It's a disaster for navigating the modern stock market. The market operates on timelines of years and decades, but your brain operates on a timeline of seconds and minutes. It mistakes the normal, healthy volatility of the market for a life-threatening predator. Two of these ancient mental glitches, or cognitive biases, are responsible for destroying more wealth than all the bad companies in the world combined. Let's put them under the microscope. Cognitive glitch number 1, the sting of loss aversion. In the 1970s, two psychologists, Daniel Kahneman and Amos Tversky, made a discovery so profound it would eventually win Kahneman the Nobel Prize in Economics.
Through a series of brilliant experiments, they proved a simple but powerful quirk of the human mind. The pain of losing is psychologically about twice as powerful as the pleasure of gaining. Think about it. If you find a $100 bill on the street, you feel great. If you lose a $100 bill, you feel horrible. The emotional impact of the loss is far more intense and lasting than the fleeting joy of the gain. This is loss aversion. Your brain is wired to avoid losses at all costs. In the stock market, this wiring backfires spectacularly. Imagine you buy a stock in a great company for $100 per share. The stock drops to $80 during a routine market pullback. Your ancient brain doesn't see a temporary market fluctuation. It screams, "Tiger in the bushes! Danger! You are losing! Make the pain stop!" The overwhelming impulse is to sell the stock just to stop the emotional bleeding. You sell at $80, locking in a real loss. A few months later, the market recovers, and the stock of that same great company is trading at $130. You sold not because the business was failing, but because you couldn't handle the temporary, on-paper pain of a downturn. Loss aversion turns temporary volatility into permanent capital loss. It is the single most destructive force for the average investor. Cognitive glitch number 2, the echo chamber of confirmation bias. The second glitch is more subtle but just as deadly. Confirmation bias is our brain's tendency to seek out, interpret, and remember information that confirms our pre-existing beliefs. We love to be right, and our brain will build a protective bubble of evidence to make sure we always feel that way. Let's say you buy a stock in a company, we'll call it Momentum Tech, because you believe it has a revolutionary new product. What happens next? You'll start noticing every positive headline about Momentum Tech. You'll click on articles titled, "Why Momentum Tech is Set to Soar." You'll gravitate toward online forums where other believers are cheering the stock on. Meanwhile, your brain will skillfully ignore, downplay, or discredit any negative information. A critical report from an analyst? They just don't get it. The company's sales figures are slowing down? It's just a temporary blip. A major competitor launches a better product? They're just a cheap imitation. You're not seeking truth, you're seeking agreement. You have become the coach of a football team who only watches his own highlight reels.
It feels great, but it gives you a dangerously distorted view of reality. When the crash comes, you'll be the most surprised person in the stadium. The solution: the great mindset shift, from renter to owner. So how do we fight back against this faulty wiring? We can't get a brain transplant, but we can perform a software update. We can intentionally install a new mindset that overwrites these self-defeating programs. This is the most important lesson in this entire book. You must shift your identity from a stock renter to a business owner. A stock renter sees stocks as flickering green and red symbols on a screen. They are abstract, disconnected things, like digital lottery tickets. The renter asks, "What's the stock doing today? Is it up? Is it down?" Their mood rises and falls with the daily price. They're highly susceptible to loss aversion and confirmation bias because they have no anchor to the underlying reality. An owner, on the other hand, understands that a share of stock is not a lottery ticket. It is a small, fractional ownership stake in a real, breathing company. A company with offices, employees, products, customers, and profits. The owner asks fundamentally different questions. Is this a good business? Do I want to be a partner in this enterprise for the next 10 years? Does it have a strong brand and loyal customers? Is the management team smart and honest? To make this crystal clear, let's use a little psychology hack I call the coffee shop test. Imagine your favorite local coffee shop announces it's for sale. You love their coffee, and the place is always busy. Would you buy it? Before you put your life savings on the line, you would become a detective. You'd want to see their financial books. You'd ask the owner about their profits and their costs. You'd research the competition down the street. You would want to understand the business. You would never ever buy it just because your neighbor yelled, "Hey, you should buy that coffee shop. It's hot right now." You must apply this exact same mindset to buying a stock. Buying a share of Apple, AAPL, is not buying a ticker symbol. It is buying a tiny slice of the most profitable consumer electronics business in human history. Buying a share of Coca-Cola, KO, is buying a piece of a global distribution network that sells billions of dollars worth of beverages every quarter. When you adopt the owner mindset, the cognitive biases lose their power. Loss aversion gets neutered.
If your coffee shop has a slow week because of bad weather, a market dip, do you panic and sell the entire business? Of course not. You understand that short-term fluctuations are just noise. You trust in the long-term strength of the business. Confirmation bias gets reversed. As the owner of the coffee shop, you desperately want to know about problems. Is a new Starbucks opening next door? Are the price of coffee beans skyrocketing? You actively seek out bad news because it's your job as an owner to be aware of threats and opportunities. This mental shift is the foundation of your entire financial fortress. Before you ever analyze a financial statement or a stock chart, you must first win the internal game. Chapter 1, Summary, the blueprint. The real game, your success or failure as an investor, will be determined by how you manage your own psychology, not by your ability to pick hot stocks. Your brain is not your friend here. Your brain's ancient survival wiring, designed for immediate threats and rewards, is horribly suited for long-term investing. The twin destroyers, two specific cognitive biases, are your primary enemies. Loss aversion. The pain of a loss feels twice as bad as the pleasure of a gain, causing you to panic sell at the worst possible times. Confirmation bias, your tendency to seek out information that confirms what you already believe, creating a dangerous reality bubble around your investments. The master key, the solution is a profound mindset shift. You must stop thinking like a stock renter, a gambler, and start thinking like a business owner, an investor. The coffee shop test. Before buying any stock, ask yourself, if this were a local business for sale, would I have done enough research to feel confident in buying the whole thing? This grounds your decision in business reality, not market speculation. Your first action steps. Commit to the mindset. Say this out loud right now. I am not a gambler. I am a business owner. A share of stock is a piece of a real business, and I will treat it as such. Perform a mental audit. Think about the last financial investment you made, a stock, a fund, or crypto. Be honest. Were you acting as a renter or an owner? Did you do your homework on the underlying business or asset, or were you just hoping the price would go up? Acknowledging your past behavior is the first step to changing it. Practice the owner's question. The next time you see a financial headline or hear stock tip that creates a strong emotional reaction, fear or greed, pause, take a breath, and ask the owner's question. What does this news actually mean for the long-term health of the underlying business? This simple act inserts logic where raw emotion used to be. Chapter 2, the two-account system, separating your brain from your money. In the last chapter, we identified the enemy, a brain that's hardwired for survival, not for investing. Now, we move from diagnosis to treatment. Knowing that you're prone to loss aversion and confirmation bias is one thing. Stopping them from hijacking your decisions in real time is another.
Have you ever had an internal argument with yourself about money? One part of you says, be responsible, stick to the plan, just buy the index fund and don't touch it for 30 years. And another, more excitable part of you whispers, but did you see that new tech stock? Everyone is talking about it. We could double our money by Christmas. Don't miss out, just a little bit. This isn't a sign of weakness. It's the human condition. This internal war is being waged by two different operating systems running inside your head. And the secret to winning the war isn't to destroy one side, but to give each side a different job. Meet the two brains in your head, the toddler brain and the CEO brain. The psychologist Daniel Kahneman, whom we met in Chapter 1, gave these two systems generic names, System 1 and System 2. To make it more intuitive, let's call them the toddler brain and the CEO brain. The toddler brain, System 1. This is your brain's default setting. It's vast, emotional, instinctive, and effortless. It operates on gut feelings, stories, and simple associations. The toddler loves excitement, hates boredom, and has the attention span of, well, a toddler. It's the part of you that gets a jolt of FOMO, fear of missing out, when a stock is soaring, and a pang of panic when it dips. It makes snap judgments and wants everything now. While it's great for dodging a ball thrown at your head, it's an absolute menace when given control of a retirement portfolio. The CEO brain, System 2. This is your analytical, logical, and deliberate mind. It's slow, requires concentration, and gets tired easily. The CEO brain is capable of complex calculations, long-term planning, and weighing pros and cons. This is the brain you want making your investment decisions. Here's the problem. The toddler is always awake, always screaming for attention. The CEO needs to be deliberately woken up, given a cup of coffee, and forced to focus. In any moment of stress, excitement, or uncertainty, the toddler brain will hijack the controls from the tired CEO. So how do we keep the toddler from blowing up the company? We don't fire it. We give it a playpen. The method, the two-account system. This is one of the most powerful organizational hacks you will ever learn. It's a practical system for managing your psychology by physically separating your money based on its purpose. You will create two distinct mental, or even better, actual portfolios. Account number 1, the fortress account. This is your serious money. This is the engine of your long-term wealth. Size, the vast majority of your investment capital. Think 90% or even 95%. This is non-negotiable. Purpose, to systematically and patiently build life-changing wealth over the long term. This account is for your retirement, your kids' college education, your financial freedom. The rules. The Fortress account is governed exclusively by the CEO brain. Every decision is slow, deliberate, and based on the owner mindset we developed in Chapter 1. The stocks or funds in this account must pass the strict, quality-first filters we will establish in later chapters. Its motto is slow and steady. You check it infrequently. Its growth is measured in years and decades, not days and weeks. This is your life's work. Account number 2, the speculation account. This is the toddler's playpen. I sometimes call it the lab because it's also where you can learn and experiment without risking your future. Size, a small, clearly defined fraction of your investment capital, no more than 5 to 10%. Critically, this must be an amount that you could lose entirely without it having any material impact on your life or your long-term goals. If losing it would cause you to lose sleep, the amount is too big. Purpose, to scratch the itch. This is where your toddler brain gets to have its fun. This is where you can act on a hot tip, buy that exciting but unproven biotech stock, or invest in a volatile new asset class. It satisfies the need for action and the thrill of the game in a controlled environment. The rules here are loose. The goal isn't necessarily to make money, though that's a nice bonus. The goal is to contain the psychological need for risky action. The only ironclad rule is the budget. Once the money is gone, it's gone. You don't get to refill it until your next planned contribution. The psychological firewall, the most important rule.
The two-account system works because it creates a firewall between your emotions and your serious wealth. The toddler can play with its toys in the speculation account and feel satisfied, leaving the CEO free to calmly and rationally build the fortress. This leads us to the single most important rule of the entire system. Money can flow from the speculation account to the fortress account, but it can never, ever flow from the fortress to the speculation account. Let me repeat that. If you get lucky on a speculative bet and double your money, you are strongly encouraged to skim those profits and move them over to the fortress, reinforcing its walls. This is turning a gamble into real wealth. But you are absolutely forbidden from taking money from your fortress to double down on a speculative bet, or even worse, to cover a loss in your speculation account. The moment you break this rule, the firewall is breached. The toddler has escaped its playpen and is now running amok in your financial future. Breaking this rule is how a small, manageable mistake turns into a life-altering catastrophe. By giving your impulsive, emotional toddler brain a sanctioned place to play, you liberate your rational CEO brain to do its most important work. You're not fighting your own nature, you're managing it. This is the architecture of discipline. Chapter 2, Summary. The Blueprint. The internal conflict, the struggle between responsible long-term investing and risky short-term gambling, is a battle between two parts of your brain, the toddler versus the CEO. We named these System 1, the toddler brain, fast, emotional, impulsive, and System 2, the CEO brain, slow, logical, deliberate. Your toddler brain is the default and will hijack your decisions if left unchecked. The two-account solution. Create a practical system to manage this conflict by separating your money into two distinct portfolios. The Fortress account, 90 to 95%, for serious long-term wealth building governed by the logical CEO brain. The Speculation account, 5 to 10%, a playpen for your emotional toddler brain to experiment with risky ideas using money you can afford to lose. The Psychological firewall. The most crucial rule is that money can only flow one way, from speculation to fortress, never the other way. This firewall protects your serious wealth from your emotional impulses. This system turns your greatest psychological weakness into a manageable part of your strategy. Your first action steps.
Define your percentages. Right now, decide on the allocation between your fortress and speculation accounts. For most people, a 95-5 split is ideal. Write it down: fortress account 95%, speculation account 5%. Calculate your numbers. Look at your total investment capital. If you have $20,000 to invest, a 95-5 split means $19,000 is for the fortress and $1,000 is for speculation. Be brutally honest with yourself. Could you sleep soundly tonight if that $1,000 vanished? If not, lower the percentage. Create the separation. The best way to enforce this is to open two separate brokerage accounts. Name one My Fortress and the other My Lab. If you can't do that, create two separate watch lists or spreadsheets. The physical or digital act of separation makes the mental firewall real. You now have a structure in place to protect you from yourself.
Chapter 3, The Architect's Blueprint, Your Personal Investment Plan. Imagine hiring a construction crew to build your dream house. They'd show up on day one, full of energy. The foreman asks, "All right, where's the blueprint?" You shrug. "Blueprint? Oh, I don't have one. Just start building. We'll figure it out as we go. Maybe put the kitchen over there, or maybe by the window. Let's see how we feel tomorrow." That crew would pack up their tools and leave. They know that without a detailed plan, the project is doomed. The result would be a chaotic, unstable, and incredibly expensive mess. It wouldn't be a dream house, It would be a nightmare. And yet, this is exactly how most people approach building their financial future. They throw money at the market based on a whim, a headline, or a feeling. They have no blueprint. When the first storm hits, a market downturn, a scary news cycle, they have nothing to guide them. They panic, make emotional decisions, and end up with a pile of rubble where their dream should be. This chapter is where we end that. Today, you become the architect. We are going to create your single most powerful weapon against fear, greed, and your own worst instincts. Your Personal Investment Policy Statement, IPS. Don't let the name scare you. An IPS is simply a written document that defines your mission, your timeline, your rules, and your boundaries before you invest a single dollar. It is the constitution for your financial life. It is the blueprint for your fortress. The Ulysses Contract, a pact with your future self. In Greek mythology, the hero Ulysses knew he had to sail past the island of the Sirens, mythical creatures whose enchanting song lured sailors to their deaths on the rocks. Ulysses desperately wanted to hear the song, but he also wanted to live. He didn't rely on willpower. He knew that in the moment of temptation, his toddler brain would take over. So he made a plan. He ordered his men to fill their own ears with beeswax so they couldn't hear the song. Then he had them tie him securely to the ship's mast with one strict order. No matter how much he begged, pleaded, or screamed, they were not to untie him until they were safely past the island. This is a perfect metaphor for what your blueprint will do. You, in a calm and rational state today, your CEO brain, are going to write down a set of rules.
These rules will bind your future self, the one who is panicking during a market crash or getting wildly greedy during a bubble. Your blueprint is your mast. It is a contract you make with yourself to protect you from yourself. Your personal blueprint will have 4 core components. Let's build it, section by section. Section 1. The mission. What are you building for? A fortress without a purpose is just a pile of rocks. Your wealth needs a why. Vague goals like to get rich or to make money are useless. They provide no emotional anchor. Your mission must be specific, measurable, and personal. Ask yourself, what is the primary goal for this money? Is it for retirement, a down payment on a house, your child's future education, financial independence? Be specific. Don't just write retirement. Write to accumulate $1.5 million by age 65, which will provide an annual income of $60,000. Be concrete. Don't just write house. Write to save a $75,000 down payment for a home in the next 7 years. This mission is the why that will keep you going when things get tough. When the market is down 20% and your toddler brain is screaming to sell, you won't look at the scary numbers. You will look at your blueprint and read, "This is for my family's future." It reframes the entire situation from panic to purpose. Section 2. The timeline. When do you need it? Your time horizon is the most powerful determinant of how much risk you can and should take. A 25-year-old investing for retirement in 40 years can afford to ignore market downturns. In fact, for them, downturns are a wonderful gift, a chance to buy more of the world's greatest businesses at a discount. A 62-year-old who needs the money in 3 years has a completely different risk profile. In your blueprint, write down your time horizon for your primary goal. This single number will dictate many of the strategic choices you make later. Section 3. The foundation. The sleep at night test. This is the most important section of your blueprint. We need to determine your true gut-level risk tolerance. Forget online quizzes that ask you abstract questions. We're going to do a visceral thought experiment. Get a piece of paper. Imagine you have successfully invested $50,000 in your Fortress account. It's real money you worked hard for. Now imagine a severe but historically normal market correction occurs. Scenario A. Your $50,000 is now worth $45,000, a 10% drop.
How do you feel? A little nervous? Unfazed?
Write down your honest, immediate emotional reaction. What is your impulse? To sell? To buy more? To do nothing? Scenario B, your $50,000 is now worth $40,000, a 20% drop. The headlines are screaming, crash. Your friends are panicking. Now how do you feel? Is your heart racing? Is the toddler screaming? What is your impulse? Scenario C, your $50,000 is now worth $35,000, a 30% drop. This is a true bear market. It feels like the world is ending. Be brutally honest. Do you feel physically ill? Do you feel an overwhelming urge to sell everything before it goes to zero? Your honest answer to Scenario C defines your real risk tolerance. There is no right or wrong answer. If a 30% drop makes you want to abandon your plan entirely, then a 100% stock portfolio is too aggressive for you right now. That's not failure. That's critical self-knowledge. Your blueprint must reflect this reality. For example, your blueprint might state, "My sleep at night number is a 25% portfolio decline. To accommodate this, I will maintain a portfolio that is never more than 70% in stocks and 30% in less volatile assets like bonds." This test turns abstract risk into something you can feel, and it allows you to build a fortress with walls you're psychologically capable of defending. Section 4. The Rules of Engagement, Your Personal Strategy. This is where you operationalize your mission. You define your actions in advance. This section should be a list of "I will" and "I will not" statements. Here are some examples you can adapt. I will invest according to the 95-5 Fortress Speculation Split. I will only add companies to my Fortress account that pass the MOAT checklist from Chapter 5. I will not buy a stock based on a media headline or a tip from a friend. I will not sell a stock simply because its price has gone down. I will only sell for reasons defined in Chapter 8. I will not check my Fortress account more than once a month. During a market crash, a 20% drop or more, I will consult this blueprint and look for opportunities to buy, not reasons to sell. Putting it all together, a sample blueprint. Here's what a finished blueprint might look like for Leo, a 35-year-old engineer. My Financial Fortress Blueprint. Leo. Mission: to achieve financial independence by accumulating $2 million in investments by age 60. This will allow my family to live comfortably without relying on a traditional job. Timeline: 25 years.
Risk Foundation. The sleep at night test showed that a 30% drop would cause me significant stress, but I would not panic sell. Therefore, I will aim for a portfolio of approximately 80% growth stocks and 20% stable ETFs or bonds. Rules of Engagement. I will maintain a 95% Fortress, 5% speculation account split. I will contribute $1,500 every month to my Fortress account automatically. I will only purchase individual stocks for my Fortress that are profitable, have low debt, and possess a clear competitive advantage. I will not sell based on market fear. I will reread this blueprint during any major downturn. I will review this plan once per year on my birthday, not daily. Do you see the power in this? This isn't just a document, it's a fortress wall. When chaos reigns, Leo won't have to think. He won't have to feel. He just has to execute the plan his calm, rational CEO brain already created. Chapter 3 Summary. The Blueprint. Build with a plan. Trying to invest without a plan is like building a house without a blueprint. It's a recipe for disaster. Your Personal Investment Policy Statement, IPS, is your blueprint. The Ulysses Contract. Your blueprint is a pact you make with your future self. Your calm, rational CEO brain of today creates rules to protect your emotional, panicked toddler brain of tomorrow. The 4 components of your blueprint. Mission, your specific, measurable, and personal financial goals. Your why. Timeline, your time horizon which dictates your capacity for risk.
Foundation, your true gut-level risk tolerance discovered through the sleep at night test. Rules of engagement, your personal list of I will and I will not statements that govern your investment behavior. Freedom through discipline. A written plan doesn't restrict you, it frees you. It frees you from anxiety, from emotional decisions, and from the noise of the market, allowing you to act with clarity and confidence. Your first action steps. Open a new document on your computer or get a dedicated physical notebook. Title it, Your Name's Financial Fortress Blueprint. This is a sacred document. Draft your sections. Go through each of the 4 sections from this chapter, mission, timeline, foundation, and rules, and write out your first draft. Don't worry about getting it perfect, just get it down on paper. Perform the test. Take 10 minutes of quiet time to honestly perform the sleep at night test. Write down your uncensored feelings and conclusions. This is the most important piece of data you will gather. Sign your contract. When you're done with your first draft, sign and date it. This symbolic act solidifies it as a real contract with yourself. You are now an architect. You have a plan. In the chapters to come, we will give you the tools to execute it.
Chapter 4. Decoding Wall Street. How to read the market's language. Let's be honest. The main reason the stock market feels so intimidating is that it seems to be spoken in a foreign language. P/E ratios, market caps, yields, EBITDA, quarterly earnings. It's a barrage of jargon designed to make you feel like you don't belong. This is not an accident. Complexity is a wall. It's a tool the financial industry uses, consciously or not, to maintain its authority and justify its high fees. It keeps you on the outside, feeling like you need a high-priced translator, a broker, or financial advisor just to participate. This chapter is the sledgehammer that will tear down that wall. We are going to translate the 4 most important Wall Street terms into plain, simple English. The goal here is not to make you an accountant, it's to make you literate. By the end of this chapter, you'll be able to glance at a stock quote and understand the story it's telling. You will no longer be an outsider. You'll be able to read the language of the market. 1. Market cap, the company's price tag. The jargon, market capitalization, or market cap. The simple translation, the total price tag of a company. Imagine you were going to buy an entire company, from its factories and patents down to the last paperclip. The market cap is the price you'd have to pay. It's calculated with a simple formula. Total number of company shares times the price of a single share equals market cap. This number is the single best measure of a company's size. It's how the market separates the giants from the dwarves. Just like in a grocery store, you have different categories of items with different price tags. Large cap, the giants. These are the household names: Apple, Microsoft, Walmart. Typically worth more than $10 billion. They're like battleships, powerful, stable, but slow to turn and grow. Mid-cap, the contenders. Companies worth between $2 billion and $10 billion. They are established but still have significant room to grow. Think of them as nimble destroyers. Small cap, the speedboats. Companies worth less than $2 billion. They can be fast, agile, and have explosive growth potential, but they are also riskier and can capsize in a storm. Why it matters? Market cap sets your expectations. You wouldn't expect a 1,000-pound gorilla to double in size overnight. Likewise, you can't expect a $2 trillion company like Apple to grow 100-fold.
Understanding a company's price tag immediately tells you what kind of growth is realistic and what kind of risk you're taking on. 2. P/E ratio, the market's hype meter. The jargon? Price to earnings ratio. The simple translation: how much hype is built into the stock price. This is the most misunderstood metric in finance, but it's simple if you think of it as a hype meter. It tells you how much investors are willing to pay for every dollar the company actually earns in profit. The formula is price of a single share divided by the company's earnings per share equals P/E ratio. Let's use our coffee shop test from Chapter 1. Coffee shop A costs $100,000 and makes $10,000 in profit per year. Its P/E ratio is 10, 100,000 divided by $10,000. You'd make your money back in 10 years if profits stay the same. Coffee shop B also costs $100,000, but it only makes $5,000 in profit. Its P/E ratio is 20, 100,000 divided by $5,000. Which is the better deal? The immediate answer seems to be shop A. But what if shop B is a trendy new brand that everyone expects to grow incredibly fast? Investors are paying a higher price today in anticipation of much higher profits tomorrow. A low P/E ratio, like 5 to 15, suggests the market has low expectations. It's a value stock. The hype meter is low. A high P/E ratio, like 30 plus, suggests the market has very high expectations for future growth. The hype meter is turned way up. Crucial nuance. A high or low P/E is not automatically good or bad. It's a measure of sentiment. A high P/E stock can be a fantastic investment if the company actually delivers on that hyped-up growth. But if it fails to meet those high expectations, the stock can crash. A low P/E stock can be a bargain, or it could be a company that's truly in trouble. The power of the P/E ratio comes from using it as a starting point for asking deeper questions. 3. Dividend yield, the owner's bonus. The jargon? Dividend yield. The simple translation, the bonus check a company pays you just for being an owner. When a stable, mature company makes a profit, it has a choice. It can reinvest all the money back into the business to grow faster, or it can share some of that profit directly with its owners. That's you, the shareholder. This cash payment is called a dividend. The dividend yield simply expresses that bonus as a percentage of the stock price, so you can compare it to other investments. Annual dividend per share divided by the price of a single share equals dividend yield.
Think of it like the interest rate on a savings account. If a stock trades for $100 and pays a $3 dividend per year, its yield is 3%. Why it matters? Dividends are a powerful signal. They often indicate a financially healthy, stable company that is no longer in a hyper-growth phase. They provide you with the real cash return on your investment, even if the stock price goes nowhere for a year. For investors in or near retirement, a portfolio of solid dividend-paying stocks can be a reliable source of income. It's the ultimate embodiment of the owner mindset. You are literally getting paid to own a piece of a business. 4. The earnings report, a 5-minute health check. 4 times a year, public companies are required to release an earnings report. These can be long, dense documents. But as an owner, you only need to check 2 vital signs to get a quick pulse on the company's health. You can find this information in seconds on any major financial news website, like Yahoo Finance, Google Finance, or your brokerage's site. Vital sign number 1, revenue, the top line. This is the total amount of money the company generated from sales. Think of it as the total cash that came into the register. The most important question here is it growing? Is the company selling more this year than it did last year? Steady revenue growth is a sign of a healthy, expanding business. Vital sign number 2, net income, the bottom line. This is the company's actual profit. After all expenses, salaries, materials, taxes are paid, this is what's left over for the owners. The question here is also, is it growing? Sometimes a company's revenue can grow, but its profits can shrink if its costs are out of control. Seeing both revenue and net income grow together is a powerful sign of a well-managed, profitable enterprise.
You don't need to read the full report. Just find the summary table, look at these two numbers, and compare them to the same quarter last year. In 5 minutes, you can get a better sense of a company's health than most people who are just gambling on the stock's price. Chapter 4 Summary: The Blueprint. Jargon is a wall, not a sign of complexity. The language of Wall Street is designed to be exclusive. Learning a few key terms empowers you to tear down that wall. Your 4 key phrases. Market cap equals the company's price tag. It tells you the company's size and sets realistic expectations for growth. P/E ratio equals the hype meter.
It tells you how much the market expects from the company in the future. It's a tool for asking questions, not a final answer. Dividend yield equals the owner's bonus. The cash a company pays you for being a shareholder expressed as a percentage. Earnings report equals a 5-minute health check. You only need to check 2 vital signs: revenue, sales, and net income, profit. Are they both growing? Your first action steps. Pick your subject. Choose a large, well-known company you are familiar with as a consumer, e.g. Coca-Cola, Nike, Home Depot. Go to a free financial website. Open your web browser and go to Yahoo Finance or Google Finance. Type the company's name or ticker symbol, e.g. KO for Coca-Cola, into the search bar. Be a detective. On the summary page, find the 4 metrics we just discussed: market cap, P/E ratio, and dividend yield. It will often be listed as forward dividend and yield. Click on the Financials tab to find the latest revenue and net income. Form a sentence. Try to describe the company using your new vocabulary. For example, for Coca-Cola, you might say, Coca-Cola is a giant large-cap company with a relatively high P/E ratio, which means the market expects steady performance, and it pays a nice dividend yield of around 3% as an owner's bonus. Its revenues and profits are stable. You've just done more fundamental analysis than 90% of retail investors. You're no longer speaking a foreign language. You're starting to become fluent.
Chapter 5: The Quality First Filter: Finding Great Businesses to Own. By now, you have a fortress mindset, a psychological firewall, a personal blueprint, and a grasp of the market's basic language. It is time to select your building materials. This is the most exciting part for many investors, but it's also the most dangerous. The world is filled with thousands of publicly traded companies, each one screaming for your investment dollars. It's like walking into a massive, noisy warehouse filled with building supplies. Some are solid granite, some are rotting wood, and some are just painted styrofoam. How do you find the granite? Most amateurs do it backward. They hunt for undervalued stocks or cheap bargains, which often leads them to buy low-quality, rotting businesses. A cheap, broken company is not a bargain. It's a trap. We're going to do the opposite. We will follow the first rule of the world's greatest investors, from Warren Buffett to Peter Lynch. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Our entire strategy is built on a quality-first approach. We will systematically ignore the vast majority of junk stocks and focus only on the small universe of elite, durable, wonderful businesses. To do this, we need a filter. We need a simple, repeatable checklist that can instantly separate the granite from the styrofoam. This is the MOAT checklist, TM. A moat, in medieval times, was a deep, wide ditch filled with water that surrounded a castle, making it incredibly difficult for enemies to attack. In business, a moat is a durable competitive advantage that protects a company from its rivals, allowing it to earn high profits for a very long time. Our checklist is designed to find companies with the strongest moats. It has 4 simple criteria. A company must pass
all 4 hurdles to even be considered for your Fortress account. M. Management. Is the leadership team skilled and shareholder-friendly? Before you partner with someone in a business, you'd want to know if they are honest and competent. It's the same with a public company. The CEO and the management team are your partners. They are the stewards of your capital. You don't need to be a corporate psychologist to assess management. You can get a clear picture by asking 2 simple questions. Do they have a track record of success? Look at the company's performance over the last 5 to 10 years.
Has revenue and profit, our vital signs from Chapter 4, generally trended upward? A good jockey tends to win on different horses. A great CEO, like a Satya Nadella at Microsoft, can transform a company and create immense value for owners. Past performance isn't a guarantee, but it's a strong indicator of competence. Do they talk and act like owners? This is the key. Read the first page of the company's most recent annual letter to shareholders. A quick web search for company name annual letter will find it. Is the CEO being honest and direct about both successes and failures? Or are they blaming everything on macroeconomic headwinds and using confusing jargon? Great leaders speak plainly. They treat shareholders like partners, not like a problem to be managed. The red flag is a CEO who is constantly making excuses, is embroiled in personal scandals, or is paid an outrageous salary while the company's stock languishes. This is not a partner you want. O. Outstanding financials. Is the company a financial fortress? A great business idea is worthless if the company is a financial mess. A wonderful company must have a wonderful balance sheet. We can cut through the complexity and check for financial strength with 2 simple metrics you can find on any financial website under the Financials or Balance Sheet tab. Consistent profitability. Look at the company's net income over the last 5 years. Is it consistently positive? Does it have a general upward trend? A company that is constantly losing money is not a business. It's a charity for its employees and suppliers. We only want to own businesses that make a profit, period. Low debt. Debt is a claim on a company's future earnings. Too much debt is like a cancer that can kill an otherwise healthy business when times get tough. A simple way to check this is the debt-to-equity ratio. Don't worry about the formula, just look for the number. A ratio below 1.0 is generally good. A ratio below 0.5 is excellent. It shows that the company is funding its growth with its own profits, not with borrowed money. The red flag, erratic profits or consistent losses, and a high debt-to-equity ratio. This is a sign of a weak foundation, like building a castle on sand. A. Advantage, the moat. Why can't a competitor crush them? This is the core of the checklist. What gives this company its durable competitive advantage? Why can customers not easily switch to a competitor?
There are 4 main types of powerful moats. Brand power, the trust moat. Think of Coca-Cola or Apple. Their brands are so powerful that they can charge a premium price for their products. People trust them and are loyal to them. A new soda company could have a better tasting product, but it could never replicate the century of global brand recognition that Coke enjoys. Switching costs, the hassle moat. This moat exists when it is too expensive, time-consuming, or risky for a customer to switch to a competitor. Think of your bank. Moving all your direct deposits and automatic payments is a huge hassle, so you stick with them even if another bank offers a slightly better interest rate. Microsoft Office is another classic example. Everyone is trained on it, and all your files are in that format. Network effects, the popularity moat. The product or service becomes more valuable as more people use it. Think of Facebook or Visa. A new social network with only 100 users is useless. A credit card network that only a few merchants accept is worthless. The bigger they get, the stronger their moat becomes. Cost advantages, the toll bridge moat. The company can produce its product or provide its service cheaper than anyone else,
often due to massive scale. Think of Walmart or Amazon. Their sheer size allows them to negotiate bottom prices from suppliers and operate massive, efficient logistics networks that no new competitor could hope to replicate. The red flag. A company whose only advantage is, we have a great product. A great product can be copied. A great moat is nearly impossible to copy. You must be able to clearly articulate in one sentence what the company's moat is. If you can't, it probably doesn't have one. T. Trend. Is the wind at their back? A great company can struggle if it's operating in a dying industry. You want to own a business that has the secular, long-term trends of the world acting as a tailwind, pushing it forward. Ask yourself, is the industry this company operates in growing or shrinking? Are there major technological or societal shifts that benefit this company? For example, a company specializing in cybersecurity has the powerful tailwind of our world's increasing digitization and the constant threat of cyber attacks. A company specializing in renewable energy has the tailwind of a global shift away from fossil fuels.
Conversely, a company that makes DVD players, no matter how well managed, is facing a powerful headwind from the trend of streaming media. Trying to succeed in a dying industry is like trying to swim upstream against a strong current. It's possible, but why make it so hard? The red flag. The company is a leader in an industry that is clearly in long-term, irreversible decline. Chapter 5 Summary. The Blueprint. Quality first. The foundation of great investing is buying wonderful businesses. We filter for quality before we ever consider price. The MOAT checklist TM. Your systematic filter for identifying high-quality companies worthy of your Fortress account. A potential investment must pass all 4 criteria. M. Management. Is the leadership team competent and shareholder-friendly? O. Outstanding financials. Is the company consistently profitable with low debt? A. Advantage. Does it have a strong, identifiable competitive moat, brand, switching costs, network effects, or cost advantage? T. Trend. Is the company operating in an industry with a long-term tailwind? Raising the bar. This checklist is deliberately difficult to pass. The goal isn't to find hundreds of stocks. The goal is to filter out thousands of mediocre ones so you can focus your attention on the truly elite businesses. Your first action steps. Choose a test subject. Pick a company that you believe is high quality. It could be one you analyzed in the last chapter or a new one you admire as a consumer. Run it through the MOAT checklist. Open your Blueprint notebook or document. Create a new page for your test subject and go through the MOAT criteria one by one. M. Find the CEO's name and do a quick search. Read the first page of the latest annual letter. O. Go to a financial website. Look at the 5-year trend for net income and find the debt-to-equity ratio. A. Try to articulate the company's moat in one sentence. Which of the 4 types is it? T. Think about the industry. Is it growing or shrinking over the next decade? Make a pass-fail judgment. Based on your research, does this company get a pass on all 4 criteria? Be tough. If it fails even one, it does not qualify for your Fortress account. Congratulations! You've just performed a professional-grade qualitative analysis and protected your capital from a potentially mediocre investment.
Chapter 6. The Right Price. When to buy without overpaying. You've done the hard work. You've used the MOAT checklist, Mike, to filter out the thousands of mediocre companies and have identified a truly wonderful business. It has great leadership, strong financials, a powerful competitive advantage, and the wind at its back. You're excited. You've fallen in love with the company. Your toddler brain is screaming, buy it now before it gets away. This is the final test of discipline, because the most common mistake an investor can make after buying a low-quality company is paying too much for a high-quality one. Think of it like buying your dream house. You find the perfect home in the perfect neighborhood with the best schools. It's everything you've ever wanted. In your excitement, you rush in and offer 50% above the asking price without a second thought. Even if you win the house, you've started in a deep financial hole. It might take a decade or more for the home's value to catch up to the price you paid. You could be house rich but cash poor for years. The same is true for stocks. A wonderful company bought at a ridiculously high price can be a terrible investment for a very long time. Your goal is not just to own the best businesses, but to partner with them at a price that makes business sense. The Investor's Creed, Benjamin Graham's Margin of Safety. The godfather of value investing, Benjamin Graham, Warren Buffett's mentor, gave us the single most important concept for protecting our capital. It is the North Star for buying stocks. He called it the margin of safety. The concept is beautifully simple. Only buy a stock when its market price is significantly below your estimate of its underlying value. Imagine a bridge with a sign that says maximum load 10 tons. If you have to drive a 9.5-ton truck across it, would you feel safe? Probably not. What if your truck only weighed 5 tons? You would drive across with total confidence. That 5-ton difference is your margin of safety. It's a buffer that protects you from unforeseen problems, a crack in the bridge, a miscalculation in the truck's weight. In investing, value is the maximum load sign, and the price is the weight of your truck. We never want to pay a price that is close to our estimate of a company's true worth. We want to buy it at a substantial discount. This discount is our buffer. It protects us if our analysis is slightly wrong or if the company hits a rough patch.
This brings us to the most important question. How do we figure out a company's underlying value without getting a PhD in finance? 3 simple tools to find the zone of reasonableness. You do not need complex spreadsheets or a crystal ball. The goal is not to pinpoint a company's exact value down to the penny. The goal is to determine a zone of reasonableness, a price range where buying the stock makes good business sense. Here are 3 simple, powerful tools to do just that. Tool number 1, the history test. Compare to its past. A company's PE ratio, our hype meter from Chapter 4, tells us how the market feels about it today. But how does that compare to how the market usually feels about it? Most financial websites have a chart showing a stock's historical PE ratio over the last 5 or 10 years. This is an incredibly valuable tool. The question, is the company's current PE ratio significantly higher or lower than its own historical average? The action? If a stable, wonderful company like Home Depot has an average PE of 20 over the past decade and is currently trading at a PE of 35, the hype meter is flashing red. The market is far more excited about it today than it usually is. This is a warning sign of overpayment. Conversely, if it's trading at a PE of 15, it's on sale compared to its own history. This might be an attractive entry point. This test prevents you from buying into the peak of a hype cycle. Tool number 2, the neighborhood test. Compare to its peers. A stock's valuation doesn't exist in a vacuum. It's also important to compare it to its direct competitors. Is it the most expensive house on the block? The question, how does the company's PE ratio compare to other high-quality companies in the same industry? The action, let's say you're looking at Nike, an MOAT company. You find its PE is 30. You then look up the PE for Adidas and Lululemon. If their PEs are around 25, you know you're paying a premium for Nike. This isn't necessarily bad. Nike's brand moat might justify that premium, but it forces you to ask, is Nike's business so much better than its rivals that it's worth paying this extra premium? This context is crucial for making an informed decision. This test prevents you from overpaying relative to the available alternatives. Tool number 3. The growth test. This is a slightly more advanced tool, but it's a secret weapon for balancing value and growth.
A high PE ratio might seem scary, but what if the company is growing its profits at a lightning-fast pace? The price-earnings-to-growth ratio helps us quantify this. The formula is simple. PE equals PE ratio / annual earnings growth rate %. A PEG ratio of around 1 is often considered a sign of a reasonably priced stock. It means you're paying a PE that is roughly equal to its growth rate, as in a PE of 20 for a company growing profits at 20% per year. A PEG ratio significantly below 1.0 can signal a potential bargain. A PEG ratio significantly above 1.5 or 2.0 suggests the stock might be overvalued, even considering its growth. You can usually find the estimated earnings growth rate on the Analysis or Statistics page of a financial website. This tool is fantastic because it adds a forward-looking element to your analysis. It helps you understand if a high PE ratio is justified by high growth. These three tools, used together, don't give you a single magic number. They give you something far more valuable: perspective. They help you determine if a great company is trading in that zone of reasonableness, giving you the margin of safety you need to invest with confidence. Chapter 6 Summary: The Blueprint. Quality is not enough. Even the world's greatest company can be a terrible investment if you overpay for it. The price you pay determines your future return. Embrace the margin of safety. This is the cornerstone of intelligent investing. Always demand a discount between the market price and your estimate of the underlying value. This is your buffer against error and bad luck. The goal is a zone of reasonableness, not a perfect price. We use simple tools to determine if a stock is fairly priced, not to predict its exact bottom. 3 practical valuation tools. The history test. Compare the stock's current PE ratio to its own historical average. Are you buying at a moment of peak hype? The neighborhood test. Compare the stock's PE ratio to its direct competitors. Are you paying a justifiable premium for quality? The growth test. PEG ratio. Balance the PE ratio against the company's earnings growth rate to see if the price is justified by its future prospects. Your first action steps. Select your valued company. Take one of the companies that passed your MOAT checklist in the last chapter's exercise. This is the company you will now put a price on. Conduct the 3 tests. Using a free financial website, find the data for your company and fill in the blanks. History test. The current PE is. The 5-year average PE is. It is currently trading above, below, or in line with its historical average. Neighborhood test. My company's PE is. Its main competitor, name your competitor, has a PE of. My company is priced at a premium or discount to its peer. Growth test. The company's PE is. Its estimated annual earnings growth is. The PEG ratio is therefore approximately. Make a judgment. Based on your findings, write one concluding sentence. At today's price, I believe company name is overvalued, fairly valued, or undervalued, and does not offer a sufficient margin of safety for a new investment in my Fortress account. This disciplined final judgment is what separates an architect from a mere speculator.
Chapter 7, The Art of the Entry, How to Build Your Positions Intelligently. The pieces are all in place. You have a fortress mindset. You have a written blueprint. You've identified a wonderful business using the MOAT checklist TM and determined that it's trading at a reasonable price, offering you a margin of safety. The moment has arrived. It's time to actually buy the stock. For most amateurs, this is a moment of pure emotion. They feel a frantic urge to get in before the stock runs away from them. They log into their brokerage account and dump their entire intended investment into the stock in a single, massive market order. This is like the construction crew from Chapter 3 showing up with all the granite for your fortress and trying to build the entire structure in one afternoon. It's reckless, clumsy, and ignores the subtle but critical art of a good entry. How you buy is nearly as important as what you buy. A disciplined entry strategy accomplishes two crucial things. It helps you manage risk, and it removes the destructive emotion of trying to perfectly time the bottom. We will explore two powerful professional-grade techniques for building your positions, one for the steady builder and one for the more active architect. Method 1. The Automatic Architect, Dollar Cost Averaging, DCA. This is the simplest, most powerful, and most psychologically sound strategy for the vast majority of investors. Dollar cost averaging is the practice of investing a fixed amount of money in a particular investment at regular intervals, regardless of the stock's price. Let's say your blueprint calls for you to invest $6,000 into a great company or an ETF. Instead of investing the full $6,000 today, you decide to invest $500 on the first of every month for the next 12 months. Look at how this simple system masterfully defeats your emotional toddler brain. If the stock price goes down, your toddler screams, "We're losing money!" But your CEO brain, guided by the DCA system, calmly says, "Excellent. Our fixed $500 now buys more shares than it did last month. We are getting a better price." DCA forces you to do what is emotionally difficult but financially brilliant. Buy more when prices are lower. If the stock price goes up, your toddler screams, "Hooray, we're brilliant!" But the DCA system keeps you disciplined. Your fixed $500 now buys fewer shares, which naturally prevents you from getting overly greedy and plowing all your money in at a potential top.
Dollar cost averaging automates intelligent investing behavior. It completely removes the impossible burden of trying to guess the market's next move. You are no longer asking the stressful question, "Is now the absolute best time to buy?" Instead, you are making a calm, confident statement. "I am going to become an owner of this great business, and I will do so methodically over the next year." When to use DCA? This is the default, go-to strategy for your Fortress account, especially for building core positions in broad market ETFs, which we'll cover in Chapter 10, or when you're investing a lump sum, like an inheritance or bonus, into a new stock position. It is discipline on autopilot. Method 2. The Tactical Architect, pyramiding into strength. This is a more advanced technique, but it's a game changer for those who want to be more active in managing their individual stock positions. It comes from the playbook of some of the world's greatest traders, and it flips conventional wisdom on its head. Most amateurs do the opposite of pyramiding. They average down. They buy a stock at $100. It drops to $80, so they buy more to lower their average cost. It drops to $60, and they buy even more, telling themselves what a bargain it is. They are throwing good money after bad, increasing their bet on a position that is actively proving them wrong. This is how you dig a very deep hole. Pyramiding is the exact opposite. It is the practice of starting with a small initial position and only adding to it as the stock proves you right by going up. Here's how it works in practice. The starter position. You identify a wonderful company at a reasonable price. You decide your full intended position is 100 shares. Instead of buying all 100 shares, you start by buying a small pilot buy of just 25 shares. This is your initial probe. You have skin in the game, but your risk is minimal. The confirmation. You now wait. You watch the stock. If your analysis was correct and it's a great company, the stock should begin to move in your favor. Let's say it rises by 5 to 10% from your entry price. This price action is the market confirming your thesis. Adding to a winner. Now you add to your position. You buy another 25 or 50 shares at this new, higher price. The final addition. If the stock continues to act well and moves higher still, you might make one final addition to bring you to your full 100-share position. The psychology of this is profound. Your largest bets are only placed when the market is validating your judgment. Your average cost will be higher, but your confidence and your odds of being in a big winner are dramatically improved. Pyramiding forces you to listen to the market's feedback instead of your own biased opinion. If your pilot buy immediately drops 10%, you've received valuable information, your timing was off, or your analysis was wrong. But your loss is on a tiny position, making it an inexpensive lesson. When to use pyramiding? This is an excellent technique for establishing positions in individual stocks within your Fortress account, or for any position in your speculation account. It is an unparalleled risk management tool. The why behind the how. Both dollar-cost averaging and pyramiding are designed to do the same thing. Replace a single, high-stakes emotional decision with a logical, process-driven approach. They shift your focus from being right on day one to building a position intelligently over time. An architect doesn't demand that the entire fortress be built in a day. They lay the foundation, wait for the concrete to set, and then methodically add the next layer. This is how you must approach your entries, with discipline, with a process, and with intelligence. Chapter 7 Summary, the blue part. How you buy matters. A disciplined entry strategy is a critical component of risk management and emotional control. The folly of lump sum buying. Going all in at once puts maximum pressure on being right immediately and exposes you to the full risk of bad timing. Method 1. Dollar-cost averaging. The strategy of investing a fixed amount of money at regular intervals. It automates buying more shares when prices are low and fewer when prices are high, removing emotion and the need to time the market. Ideal for most investors and ETFs. Method 2. Pyramiding into strength. The advanced strategy of starting with a small position and only adding to it as the stock price moves in your favor. This forces you to add to your winners, not your losers, and is a powerful risk control tool for individual stocks. Process over prediction. Both methods replace the stress of prediction with the calm of a process. They turn a single, scary decision into a series of manageable, logical steps. Your first action steps. Choose your default strategy. Based on your personality and the amount of time you want to dedicate, decide which entry strategy will be your primary method for your Fortress account. For 90% of people, DCA is the right answer. Write it in your blueprint. My primary entry method will be dollar-cost averaging. Simulate a DCA purchase. Take the company you analyzed in the last chapter. Let's say you plan to invest $12,000. Write out a simple schedule. I will invest $1,000 in company name on the first trading day of each month for the next 12 months. This simple act makes the plan tangible. Simulate a pyramid purchase. If you're more adventurous, take that same $12,000 investment and map out a pyramid. Plan for company name, full position size equals $12,000, 1. Pilot buy, $3,000, 2. If stock rises 8%, add $4,000, 3. If stock rises another 8%, add final $5,000. This pre-planning removes emotion from the decision-making process when the time comes to act.
Chapter 8. The hardest decision. When to sell a stock. If buying a stock is an act of optimism and analysis, selling it is an act of pure, gut-wrenching emotion. Every investor knows the feeling. You own a stock that has doubled in price. Your toddler brain is in a frenzy, screaming two contradictory things at once. Sell now and lock in that profit before it disappears, and don't sell. This thing is going to the moon. You'll miss out on even bigger gains. This is the paralysis of greed. Or you own a stock that has fallen by 30%. Your toddler brain is now in a state of panic and denial. It screams, sell it now and stop the pain, cut your losses, while simultaneously whispering,
Don't sell. If you sell, the loss becomes real. Just hold on, it has to come back eventually. This is the paralysis of fear and hope. Amateur investors make their selling decisions in these moments of peak emotional chaos. They buy on logic and sell on impulse. The architect of a financial fortress does the exact opposite. Just as we created a blueprint for what to buy and how to buy it, we must create an even stricter blueprint for when to sell. Your selling decisions must be made with the cold, detached logic of your CEO brain, and they must be made before the moments of emotional chaos arrive. You must understand this critical rule. You do not sell a stock because its price has changed. You sell a stock because the underlying reason for owning it has changed. The price is just noise. The business is the reality. There are only 3 valid, logical reasons to sell a high-quality stock from your Fortress account. Memorize them. Write them in your blueprint. Tattoo them on the inside of your eyelids. They are your shield against emotional error. Reason number 1. The fortress wall has cracked. The fundamentals have deteriorated. This is the most important reason to sell. You bought the stock because it was a wonderful business that passed your MOAT checklist. You must sell it if it no longer passes that same test. The business you bought is no longer the business you own. M. Management change. Did the brilliant owner-focused CEO who built the company just retire and get replaced by a smooth-talking salesperson with a history of destroying shareholder value? This is a major red flag. O. Outstanding financials worsen. Is the company no longer consistently profitable?
Did it just take on a mountain of debt to fund a risky acquisition?
If the financial health deteriorates for multiple quarters in a row, the foundation of your investment thesis is cracking. A. Advantage. The moat is breached. This is the most critical one. Did a new, disruptive competitor emerge that is eroding the company's competitive advantage? Did a patent expire? Did the brand suffer a catastrophic, unrecoverable blow? When you can no longer clearly articulate the company's moat, it's time to sell, because its long-term profit-making ability is now in question. T. Trend reverses. Is the secular tailwind that was pushing the company forward now turning into a headwind? Has a new technology made the company's entire industry obsolete? How to act? This isn't a hair-trigger decision. One bad quarter is not a broken business. But if you see a negative trend developing over 2 or 3 quarters, if the company would fail the MOAT checklist if you ran it through today, then you must act. You sell not because the stock is down, but because the business is no longer a fortress-quality asset. Reason number 2, you made a mistake. The oops button. This is the hardest sell reason for your ego, but it's essential for your portfolio. Sometimes, despite your best efforts, you get the analysis wrong. Perhaps you thought the company had a powerful brand moat, but you later realize its customers are not loyal at all. Perhaps you misjudged the competence of the management team. Perhaps you missed a key weakness in the company's financials. The moment you realize your original investment thesis was flawed, you must sell. It doesn't matter if the stock is up or down from your purchase price. Holding on, hoping that your mistake will somehow magically turn into a success, is not a strategy. It's a prayer. How to act? Sell immediately. Every day you continue to hold a stock you know you shouldn't own based on a flawed thesis is a day you are exposing your capital to unnecessary risk. The best investors are not those who are never wrong. They are those who are quickest to admit when they are wrong and correct their mistakes swiftly. Taking a small loss on a mistake is a victory. It's a lesson you paid for. Reason number 3, you found a better fortress. Opportunity cost. Your capital is not infinite. Every dollar you have invested in one company is a dollar you cannot invest in another. This concept is known as opportunity cost.
Occasionally, you will come across a new investment opportunity that is demonstrably superior to one of your current holdings, that it makes clear business sense to make a switch. This is a very high bar to clear. It's not about selling a good company to buy another good company. It's about selling a good company to buy a spectacular one that is trading at a much more attractive price. The question: is this new opportunity not just 10% better, but dramatically better than my weakest current holding? Does it have a wider moat, better financials, a stronger growth trend, and a more attractive valuation? How to act. Be very careful here. This can be a trap for the grass is always greener mindset. You should only act on this reason sparingly. Force yourself to write down, side by side, the bull case for your current holding and the bull case for the new opportunity. If the case for the new company is overwhelmingly stronger, then making a switch is a smart, unemotional business decision. You are pruning the weakest part of your garden to plant a stronger tree. The one reason you never sell. It's worth repeating. You do not sell a great company simply because the price went up. This is the biggest mistake successful long-term investors avoid. Selling a big winner just to lock in a gain is like trading your star quarterback after he wins one Super Bowl. The great compounding machines of wealth, the Apples, the Amazons, the Home Depots, are the stocks that people sold far too early. Your goal as a fortress builder is to own these wonderful businesses for years, even decades, and let them work their compounding magic for you. Chapter 8 Summary: The Blueprint. Sell with a plan, not a panic. All selling decisions must be predetermined and based on business logic, not on stock price movement or emotion. Price is not a reason. You never sell a stock simply because its price has gone up, greed, or down, fear. The 3 valid reasons to sell a fortress stock. The fortress wall has cracked. The business fundamentally deteriorates and would no longer pass the MOAT checklist trademark. You made a mistake. You realize your initial analysis and reason for buying was flawed. You found a better fortress. A new opportunity is demonstrably and significantly superior to your weakest current holding. Opportunity cost. The cardinal sin of selling. The worst financial mistake for many is selling a wonderful compounding business too early just to lock in a small profit.
Let your winners run. Your first action steps. Update your blueprint. Go to your investment policy statement document. Create a new section called My Selling Rules. Write down the 3 valid reasons for selling. This is now part of your constitution. Conduct a sell audit on a current holding. Pick one stock you currently own or one you analyzed in the previous chapters. Go through the 3 selling criteria as if you were considering selling it today. Does this company still pass the MOAT test? Looking back, was my original reason for buying this stock sound, and is it still true today? Is this the weakest holding in my ideal portfolio? This exercise trains you to think like a seller without the emotional pressure of a volatile market. Make a watch list, not a hit list. If a company starts to show early signs of weakness on one of the MOAT criteria, don't panic sell. Put it on a watch list. This means you will analyze its next earnings report with extra scrutiny. This replaces impulsive action with a disciplined monitoring process.
Chapter 9. The Fortress in a Storm: How to Survive and Thrive in a Market Crash. The headlines are glowing red. The market is in free fall, down 20, 30%, maybe more. Financial news channels have switched to their markets in turmoil graphics. Experts are using terrifying words like capitulation, contagion, and black swan. Your friends and family are panicking. Your portfolio's value is shrinking by an amount that makes you feel physically ill. This is the storm. This is the moment that separates the amateurs from the architects. For the unprepared investor, a market crash is a wealth-destroying nightmare. Their toddler brain takes complete control, fueled by a primal fear of loss. They sell everything near the bottom, locking in devastating losses and ensuring they miss the eventual recovery. They swear off stocks forever, their financial dreams in ruins. For the architect of a financial fortress, a market crash is something else entirely. It is not a threat. It is the single greatest opportunity for wealth creation that you will ever experience in your lifetime. This is not hyperbole. This is historical fact. The fortunes of a generation are made by those who have the courage and the preparation to act when everyone else is paralyzed by fear. This chapter is your preparation. It is your storm survival guide. A scientific experiment in fear, the bear market illusion. Let's conduct a quick scientific experiment. Imagine two scenarios. Scenario A, your favorite store announces a 30% off everything must-go sale. Every high-quality item you've ever wanted is now available at a massive discount. How do you feel? Excited? Eager? You rush to the store with your shopping list ready to buy. Scenario B, the stock market, which is simply a store where you can buy ownership in the world's greatest businesses, announces a 30% off sale. How do you feel? Terrified? Sick to your stomach? You want to run away and hide. Why the completely opposite reaction? The items for sale haven't changed. A share of Coca-Cola is still a share of Coca-Cola. A share of Microsoft is still a share of Microsoft. The only thing that has changed is the price tag. The difference is a powerful psychological illusion. In the store, you are grounded in your identity as a consumer. Your goal is to acquire goods at the best possible price. In the stock market, most people are trapped in the identity of a speculator.
Their only frame of reference is the recent price, so a lower price feels like a loss, not a bargain. Your owner mindset is the cure for this illusion. A market crash is the Black Friday sale for business owners. It is the moment you have been preparing for. The inconvenient truth: market crashes are inevitable and healthy. Before we can exploit a crash, we must accept a fundamental truth. Market crashes are a normal, recurring, and even healthy part of the economic cycle. They are not a bug, they are a feature. They shake out the speculative excess, punish bad businesses, and transfer wealth from the impatient to the patient. Let's look at the data. Since World War II, the U.S. stock market has experienced a bear market, or a drop of 20% or more, roughly once every 5 to 6 years on average. Think about that. Expecting to invest for decades without experiencing a market crash is like living in Chicago without ever experiencing a winter. It's a fantasy. But here is the second and more important part of that data. 100% of past bear markets in the U.S. stock market have been followed by a new all-time high. Every single one. The recoveries are not always swift, but they are inevitable, as long as the engine of human ingenuity and corporate earnings continues to run. A crash is a temporary event. Your financial plan is a permanent one. You win by outlasting the storm. Your market crash action plan. The storm checklist. When the storm hits, you do not need to think. You do not need to feel. You need to execute a pre-written plan. This is your Ulysses contract from Chapter 3 in its most critical application. Here is your checklist. Step 1. Do nothing for 48 hours. When you first see the sea of red, your immediate impulse will be to do something. Fight that urge with everything you have. The first and most important action is inaction. For 48 hours, you are forbidden from logging into your brokerage account to place a trade. This cooling off period allows the initial wave of panic, the toddler brain's adrenal-fueled screaming, to subside. It allows your CEO brain to come online. Step 2. Read your blueprint out loud. Take out your financial fortress blueprint. Read your mission statement. Read your timeline. Read your risk foundation. Remind yourself that you planned for this. You knew this would happen.
You built your fortress with stone, not straw, precisely for this moment. This act grounds you in your own logic and reminds you that your goals haven't changed just because the market is having a tantrum. Step 3. Prepare your shopping list. Now the work begins. It's time to go on the offensive. A crash presents two main opportunities: strengthening core positions. Look at the high-quality MAOT stocks and ETFs you already own. Are these still wonderful businesses? If the answer is yes, the crash has given you a gift, the chance to add to your best ideas at a significant discount. Buying the ones that got away. Every long-term investor has a watch list of spectacular companies that have always felt too expensive to buy. Perhaps a high-flying tech company with an impenetrable moat, always traded at a PE of 80. During a crash, its price might get cut in half, bringing its valuation down into the zone of reasonableness for the first time in years. This is your chance to finally buy that dream house when it's on sale. Make a prioritized list of 3 to 5 companies or funds you will buy if the market continues to fall. Step 4. Execute your buys methodically. You will not try to time the exact bottom. That is a fool's errand. Instead, you will deploy your available cash reserves using the same disciplined entry strategies from Chapter 7. You might decide to invest a portion of your cash for every additional 5% the market drops, or you might use dollar-cost averaging to invest a fixed amount every 2 weeks until your cash is deployed. The method isn't as important as the discipline. By buying methodically on the way down, you guarantee that you will be deploying capital when fear is at its peak, the very definition of buying low. Every dollar you invest during a crash is a supercharged dollar. It is a seed planted in the most fertile soil, destined to produce the greatest returns when the sun inevitably comes out again. Chapter 9 Summary: The Blueprint. A crash is an opportunity, not a threat. A market crash is the single greatest wealth creation event for a prepared investor. It's a 30% off sale on the world's greatest businesses. Crashes are normal and inevitable. Market downturns are a recurring feature of the economic cycle. Expect them, prepare for them, do not fear them. Outlast the storm. Historical data shows that every bear market in U.S. history has been followed by a recovery to new highs. Your job is to have the plan and the fortitude to remain invested.
Your Market Crash Action Plan, a pre-written checklist to execute when fear is highest. Do nothing for 48 hours. Let the initial panic wave pass. Read your blueprint. Re-anchor yourself in your long-term goals and logic. Prepare your shopping list. Identify the high-quality assets you want to buy at a discount. Execute methodically. Deploy your cash using a disciplined system like DCA, not by trying to time the bottom. Your first action steps. Create your "in case of fire, break glass" document. Open your blueprint and create a new section called Market Crash Action Plan. Write down the 4 steps above. This is your emergency procedure. Establish a dry powder fund. Great opportunities are useless without the cash to act on them. Decide on a percentage of your portfolio that you will try to keep in cash or cash equivalents, like a money market fund. This is your storm fund. Build your dream shopping list today. Don't wait for the crash to start researching. Make a list of 3 to 5 fortress-quality companies that you would love to own if they were 30% cheaper. Do the MOAT analysis today. When the sale happens, you won't have to think. You'll just have to look at your list and act.
Chapter 10. The Prefabricated Fortress: The Smart Way to Use ETFs. Throughout this book, we have been learning the skills of an architect, how to find, value, and manage individual, high-quality businesses. It is a rewarding and powerful path to building wealth, but it is not the only path.
Let's be realistic. Not everyone has the time, energy, or desire to research individual companies. Some people have demanding careers, young families, or simply other passions they'd rather pursue. They understand the importance of owning a fortress, but they don't want to lay every single brick themselves. If this sounds like you, this chapter may be the most important one in the book. It is the ultimate permission slip to achieve incredible investment success with a fraction of the effort. We are going to talk about the single greatest financial innovation for the average person in the last 50 years, the prefabricated fortress. I'm talking about low-cost index funds and exchange-traded funds, ETFs. What is an ETF, the ultimate investment bundle? Imagine instead of having to go to the grocery store and pick out the perfect apples, the best flour, the finest sugar, and the right spices to bake a pie, you could simply buy a delicious, professionally made pie right off the shelf. That's what an ETF is. An exchange-traded fund ETF is a single stock that you can buy and sell, but it holds a diversified bundle of many different underlying stocks or other assets like bonds. The most popular type of ETF is an index fund. An index is simply a list of stocks that represents a slice of the market. The most famous is the S&P 500, which is a list of the 500 largest and most profitable public companies in America. When you buy one share of an S&P 500 ETF with tickers like VOO or SPY, you are not buying one company. You are instantly buying a tiny fractional ownership stake in all 500 of them: Apple, Microsoft, Amazon, Johnson & Johnson, Coca-Cola, and 495 others. You are buying the entire haystack, not searching for the needle. The overwhelming case for a prefabricated fortress. For years, a fierce debate has raged. Is it better to pick your own stocks, active investing, or just buy the whole market, passive investing? The evidence is not just clear, it is overwhelming.
Numerous studies, most famously SPIVA, S&P indices versus active, have shown year after year, decade after decade, that the vast majority of professional, full-time, highly paid fund managers fail to beat the market average over the long run. Think about that. The people with PhDs, with teams of analysts, with direct lines to CEOs, the very experts who make investing seem so complex, consistently fail to do better than you could by simply buying one S&P 500 ETF and holding it. Why? Two reasons. Fees. Active managers charge high fees for their expertise. These fees act as a constant drag on performance, like trying to run a race while carrying a backpack full of rocks. Low-cost ETFs have minuscule fees, often less than 0.05% per year, so you keep almost all of the market's return. Difficulty. Picking winning stocks consistently is incredibly difficult, even for the pros. The market is forward-looking and highly efficient. By buying an index fund, you guarantee you will own all the big winners that drive the market's returns. Building a prefabricated fortress with ETFs isn't settling. For most people, it is the mathematically superior, psychologically simpler, and most time-efficient path to stock market success. How to build your prefabricated fortress. The two-fund solution. You don't need a complex portfolio of a dozen different ETFs. For most people, a simple, elegant, and incredibly effective fortress can be built with just 2 or 3 low-cost funds. Brick number 1, the U.S. total stock market, the engine. This is the core of your fortress. An ETF that tracks the total U.S. stock market, like VTI or ITOT, gives you ownership in not just the 500 largest companies, but over 3,000 of them, including mid-cap and small-cap companies. It is the ultimate diversification tool, giving you a piece of the entire American economic engine. Brick number 2, the international stock market, the global walls. The U.S. is not the only place where great businesses exist. An international stock market ETF like VXUS gives you ownership in thousands of companies across developed and emerging markets in Europe, Asia, and around the world. This adds another powerful layer of diversification, so your fortress isn't dependent on the success of a single country's economy. Optional reinforcement, the bond market, the moat's water.
For investors who learned from the sleep at night test in Chapter 3 that they have a lower risk tolerance, adding a total bond market ETF like BND can be a wise move. Bonds are essentially loans to governments and corporations. They are far less volatile than stocks and act as a shock absorber during market crashes. When stocks are down, bonds tend to hold their value or even go up, providing stability and dry powder you can use to buy more stocks on sale. A common starting allocation for a long-term investor might be 60% U.S. total stock market ETF, 30% international stock market ETF, 10% total bond market ETF. That's it. With just these 3 funds, you own a professionally diversified global portfolio of thousands of companies and bonds, all for an incredibly low cost. This is a fortress that would make institutional investors proud, and you can build it in less than an hour. The architect's role in a prefabricated world. Just because you choose a prefabricated fortress doesn't mean the lessons from this book don't apply. Your role simply shifts from being a bricklayer to being the disciplined commander of the fortress. You still need your blueprint in Chapter 3 to define your goals and risk tolerance, which will determine your mix of stock and bond ETFs. You still need to use dollar cost averaging, Chapter 7, to invest consistently every month. You absolutely must have a market crash action plan, Chapter 9, to give you the courage to keep buying when the market is on sale. And your selling rules are even simpler. You only sell when you need the money for your stated goal, like retirement, or to periodically rebalance your portfolio back to its target percentages. The ETF path doesn't absolve you of the need for discipline. It simply focuses your discipline on the few behaviors that matter most: saving, investing consistently, and staying the course. Chapter 10 Summary. The Blueprint. The Prefabricated Fortress. For those who lack the time or desire to pick individual stocks, building a portfolio with low-cost ETFs and index funds is a powerful, effective, and often superior strategy. What is an ETF? A single stock that holds a diversified bundle of many underlying assets. Buying one share of an S&P 500 ETF instantly gives you ownership in 500 of America's top companies. The evidence is clear. The vast majority of professional active managers fail to beat the market average over time, mainly due to high fees.
Buying a low-cost index fund is the simplest way to guarantee you capture the market's return. The simple 2-fund or 3-fund solution. A globally diversified, robust portfolio can be built with just 2 or 3 ETFs, a U.S. total stock market fund, an international total stock market fund, and an optional total bond market fund for stability. The commander's role. Choosing ETFs doesn't eliminate the need for discipline. Your role shifts from stock picker to the commander who ensures you stick to your blueprint, invest consistently, and hold firm during storms. Your first action steps. Make a strategic choice. Be honest with yourself about your time and interest level. In your blueprint, write down your chosen path. My strategy will be to pick individual MOAT stocks. Or, my strategy will be to build a prefabricated fortress with low-cost ETFs. Or, my strategy will be a hybrid, a core of ETFs with a satellite of a few individual stocks in my speculation account. There is no wrong answer. Research your building blocks. Go to the website of a major low-cost brokerage firm like Vanguard, Fidelity, or Charles Schwab. Look up the 3 types of ETFs mentioned: a U.S. total stock market ETF, e.g. VTI, an international stock market ETF, e.g. VXUS, a total bond market ETF, e.g. BND.
Note their ticker symbols and their incredibly low expense ratios, fees. Design your prefab model. Based on your risk tolerance from Chapter 3, decide on your ideal allocation. A young, aggressive investor might choose 70% U.S., 30% international. A more cautious investor might choose 50% U.S., 20% international, 30% bonds. Write this model down in your blueprint. You now have a complete, professional-grade investment plan ready for execution.
Chapter 11. Building Your Legacy, the Lifelong Investor. We have come a long way. We began as outsiders, staring at a locked door. Now, you stand as the architect and commander of your own financial fortress. You have the mindset, the blueprint, the tools, and the discipline to turn the stock market from a source of anxiety into a powerful engine for your family's future. But the construction of a fortress is not the end of the story. A great fortress is not a static monument to be admired. It is a living structure that must be maintained, adapted, and, ultimately, passed on. Your final transformation is to evolve from an investor into a legacy builder. This means shifting your time horizon from years to decades, and from your own life to the lives of those who will come after you. It's about ensuring that the security and opportunity you've built for yourself endures. This chapter covers the 3 final pillars of becoming a lifelong investor: adaptation, education, and transmission. Pillar 1. Adaptation. Adjusting the fortress for the seasons of life. Your financial life is not a straight line. The 80% stock portfolio that was perfect for you as a 30-year-old with a long time horizon may not be appropriate for you as a 65-year-old about to enter retirement. A great fortress adapts to the changing landscape. The primary adaptation you will make is a gradual and deliberate shift in your asset allocation as you approach your goal. This is known as a glide path. The accumulation phase, your 20s, 30s, 40s, and early 50s. During these years, your greatest asset is time. Your portfolio should be geared for maximum growth. This means a heavy allocation to stocks, whether through individual moat companies or stock ETFs. Perhaps 80 to 90%. Your job is to accumulate as many shares of great businesses as possible. The preservation phase, 5 to 10 years before retirement, as you get closer to the date you'll need to start drawing income from your fortress, you must begin to reduce your risk. You can't afford a 40% market crash the year before you retire. This is when you begin to systematically sell some of your stock holdings each year and move the proceeds into less volatile assets, primarily bond ETFs, the moat's water from Chapter 10. You might shift from an 80-20 stock-bond mix to a 60-40 stock-bond mix. This transition should be gradual, not a sudden, panicked move.
The distribution phase, retirement. Now your fortress shifts from a growth engine to an income generator. Your portfolio, perhaps a 50-50 or 40-60 stock-bond mix, is designed to provide a steady stream of cash to live on, while still keeping enough in stocks to outpace inflation and continue growing. This is when you harvest the fruits of your decades of discipline. This adaptation is not market timing, it is life timing. It is a planned, logical transition managed by your CEO brain, ensuring your fortress serves its purpose at every stage of your life. Pillar 2. Education, sharpening the saw. The world changes, new industries emerge, new technologies disrupt old ones. While the core principles of the financial fortress framework are timeless, the world in which you apply them is not. Becoming a lifelong investor means committing to being a lifelong learner. This doesn't mean you need to be glued to financial news. In fact, that's counterproductive. It means dedicating a small amount of time to sharpening your saw. Read voraciously. Go back to the source.
Read the annual letters of great CEOs and investors like Warren Buffett at Berkshire Hathaway or Jamie Dimon at JP Morgan Chase. They are masterclasses in clear, long-term business thinking and investor psychology. Follow thinkers, not tickers. Identify a few high-quality financial writers, podcasters, or thinkers who focus on long-term business analysis and investor psychology, not on short-term market predictions. Reread this book and your blueprint. Once a year, take an afternoon to reread this book and, more importantly, your own blueprint. It will be shocking how the lessons resonate differently as you gain more experience. It will recenter you on the principles that matter and remind you of the contract you made with yourself. This commitment to learning keeps your mind sharp, your strategy relevant, and your CEO brain firmly in command. Pillar 3. Transmission, teaching the next generation. What is the purpose of a fortress if not to protect those within it and provide a safe haven for future generations? The final and most meaningful act of a legacy builder is to pass on not just your wealth, but your wisdom. Leaving your children a large inheritance without teaching them the principles of how it was built is often a curse, not a blessing. It can stifle ambition, create dependency, and be squandered in a fraction of the time it took to build.
The greatest inheritance you can give is the knowledge contained in this book. Start the conversation early. Talk about money, openly and without shame. Use the coffee shop test from Chapter 1 to explain what a stock is. When you buy groceries, explain the difference between being a consumer at the store and an owner of the company that makes the products. Give them a seedling account. When they're teenagers, help them open a small custodial investment account. Let them choose a moat company they understand and admire, like Apple, Nike, or Starbucks. Let them use their own money to buy 1 or 2 shares. This transforms them from passive observers into active owners. They will learn more from watching that small position than from any lecture. Share your blueprint. When they are young adults, sit down and share your financial fortress blueprint with them. Explain your mission, your rules, and your mistakes. Show them the architecture of your success. You are giving them a map that took you a lifetime to draw. This is your true legacy. A legacy of wealth is finite. A legacy of wisdom is infinite. It is a gift that will empower your children and their children to build fortresses of their own.
Conclusion: you are the architect. We began this journey standing before a locked door, convinced that the world of financial success was not for us. Today, that door is wide open. More than that, you now realize it was never truly locked. The key was simply a new way of thinking. You now possess that key. The Financial Fortress Framework TM is yours. You have learned to conquer your own psychology, to create a disciplined plan, to identify wonderful businesses, to buy them at a fair price, and to hold them with the conviction of a true owner. You know how to weather the inevitable storms and how to build a simple, powerful portfolio, even if you never want to analyze a single stock. The feeling of being on the outside looking in is gone, replaced by the quiet confidence of the architect. The anxiety of a chaotic market has been replaced by the calm of a written plan. The fear of the future has been replaced by the excitement of building it. The rest is up to you. This book can provide the knowledge, but only you can provide the action. The single greatest determinant of your financial destiny will not be the market's performance or the economy's direction. It will be your behavior. Your future is a structure yet to be built. You hold the blueprint. You have the tools. You are the architect. Now, go build your legacy.